All right, here we are with part 2 for chapter 12. We're going to practice another type of bond. So Archer Spy Supplies, again, issued a $70,000 10-year, 9% bonds payable on January 1st, 2018. And they have interest payments January 1st and July, and it will be, if it's discount or a premium, it'll be amortized using the straight line method. And so let's go ahead and do the next type of problem. And so we have here just me asking you what type of bond is issued at 92. So we're going to journalize an issuance of a bond at 92. So I'm asking you what type of bond? Well, think of 92 as a percentage. So the bond is issued at 92%. That's less than 100%. And so what type of bond is that? Well, that is a discounted bond. So our answer is discount. So that's what we're going to practice now. Okay. And so we want to think of it as, and let's change this so it's not bolded. Only 92% was received as cash. And so as we're thinking about this, just as a reminder, hopefully you read the book and have a good idea of a discount on a bond already. But as a reminder, a bond trades at a discount when the interest rate is less than the prevailing coupon rate. And so our coupon rate is actually, oh, I made the screen big here by accident. So our coupon rate is actually at 9%. We can see here, 9%. So out there in the market, it is probably maybe 10 or 11%, something like that, slightly higher than what the coupon rate, what Archer Spy Supplies is issuing it at. They're only able to issue it at 9%. So what is the incentive for someone to give them, to issue them a bond and give them cash? Well, they're going to give you less cash then, if they're going to only get less than the prevailing interest rate out there. And so that's why we're only going to receive 92% was received as cash. So getting back to that, just the simple math of 70,000, all right, at that face value times 92%. And so that equals, well, let's get our calculator. 64,400. All right, that is how much cash is going to be received. But at maturity, the full note amount is due. So let's write it this way. The full note amount is due at maturity. And what was the full note amount? Well, the 70,000. So in 10 years, they're going to still pay of the bond for the full 70,000, even though they got less cash. And so we can see here already as we're looking at it that we're out of balance. Our debit or cash that's being received is going to be lower than our bond payable credit. And so what's that difference? Well, that difference is the discount on the bonds payable. That was the discounted amount. And so let's go ahead and record this journal entry with that analysis. So January 1st, we received only 64,400. We just did the math for that. That was the 92%. Oh, geez, here we go. And then I'll leave a space there, but we already analyzed it, but let's go ahead and leave a space there. And we know our credit for sure is the full amount of the note that's due at 70,000. And so here, our difference, well, we can see that we need a debit to balance. And so that is our discount on bonds payable. So now you're really thinking, okay, for premium, then its balance would be a credit. And so here we have, for discount, its balance will be a debit. So we can just remind ourselves that 70,000 minus 64, right? And I did this last because this is like our plug, because we know our debits and credits need to equal. So if we add up our two debits, we do equal our credit. So this if you didn't know, what its normal balance was for discount. Or if you were confused about the concept, well, you can see you can save it for last and then do that plug of the difference to help you out. All right, so let's keep going. Well, now we're going to do the interest. So we're going to make the payment of the semi-interest annual interest on that bond that was issued at a discount. And so we'll have a little bit of math, just like we did in the face value one. And so let's just do a reminder, since this is a new video of it. We had the principal times rate times time, right? And so that was the 70,000 times the 0.09 times 6/12, because it was semi-annual. And the 0.09 again, that was when it was issued at. Okay. And so that is 3,150. Well, our bond was issued at a discount. So that is actually not going to be our interest expense. Our interest expense is going to be slightly different, but this is going to be our cash payment. So this is the cash payment. We're actually going to get to expense a little more for interest expense in a discount. And that's because we have to amortize that bond discount. And so we're going to amortize that using the straight line method. And that bond discount, I'll just scroll up a little bit, is 5,600. So we're going to start chipping away at this debit balance. Okay, so we're going to start chipping away of it by doing a credited amount for a small amount, chipping away at it. And so how much are we going to chip away at it with the straight line method? Well, it is a 10-year bond. So let's go back and remind ourselves of the problem. It is a 10-year bond, and it pays interest semi-annual, right? Twice a year. Okay. And so if it's 2 payments each year and there's 10 years, how many payments am I going to make? Well, 10 times 2 is 20. So I'm going to be making 20 payments. So let's go back down and let's write this out for you. Make a little heading there. So that 5,600, scroll up so you can see, remember where it's at, where it's coming from. So that 5,600 is the discount for 10 years, and it's semi-annual, will equal 20 payments. That's quick notes for that. I'll write it better for the actual written instructions, but at least we have that for now. So we're going to have to amortize this using straight lines. So we'll say 5,600 divided by 20. All right. And that equals 280. So 56 divided by 2. So that's $280 each payment that we're going to chip away at that discount on bonds payable. So let's just remind me that this is the discount on bonds payable. That way, as I'm doing my journal entry, I know what everything is for. So let's bring this over and say, okay, this is my cash payment. So that's cash going out. This is my discount, my amortization of that discount on bonds payable. And we know that it needs to be a credit to chip away at it. And then what do we have left? Our interest expense. So my interest expense, let's scroll up now. Will equal the cash payment plus the discount. All right, and so I get to expense slightly more when it's a discount. So that's the little benefit about that. Still got less cash up front, but again, gets to expense a little higher amount of interest expense as a result. So the incentive for that investor was that they gave, since they were going to get less interest payment than what the rate was out there in the market, their incentive was okay. They only had to give 64,400 up front in cash, and so that was the incentive for them to give them that cash up front. Loans payable or credit, and then we have my cash. All right, and this was the interest expense. Let's highlight that. And we can see we are in balance. My credits added up does equal my debit, and we analyzed all three parts of that entry here with some math. Okay, in the next video, we'll do a premium.